the bond market may be figuring this out. We'll see. And we would have the 10-year yield actually moving back down towards 2% by the end of this year.
Yeah, and everyone's been watching the 10-year Treasury bond yield like hawks, and those in the first camp were sure that it was going to break the downtrend that's been in place. Really, if you go, you have to go back to 1981 to see the beginning of the downtrend. The Treasury bond yield peaked at around 15% back then, and the trend has been down. I think those expecting a breakout are being disappointed as we speak. And I'm surprised that the stock market isn't picking up more on this because interest rates, the long-term Treasury yield, this one, went to 320 and now has backed down to 280. So that's 40 basis points in maybe 2 weeks. Which is a very rapid move. So the bond market, and remember, this is a 10-year Treasury yield, and I always like to think of it in terms of, okay, this is what the bond market thinks nominal GDP will be doing for the next 10 years, give or take. So 3% or 2.8% nominal GDP growth over the next 10 years. Well, that must mean one of two things. Either growth is disappointing or inflation's disappointing or both. Or if you're in our world, in the disruptive innovation world, we think unit growth measured correctly is going to surprise hugely on the high side of expectations, and that inflation is going to turn down. And we would not be surprised over time to see it go negative once more, because disruptive innovation is becoming a much bigger base in the economy. Electric vehicles, when we first started ARC, weren't even, they were probably not even 20,000 vehicles. That was 2014. Last year, we were up at 4.8 million units. This year, we think we could be close to 7.5 million units globally as the consumer preference shift accelerates towards electric. And so, that's approaching 10% of all auto sales.
Wow. So I'm totally on board. We have what we call is the manufacturing renaissance, which the digitization theme, the robotics theme, where one thing the COVID crisis did do, to be sure, definitely companies realized the importance of automation, digitization, making their businesses more productive. And at the same time, we have an onshoring into this country, which is creating a lot of good jobs in the middle part of this country. And so capital spending, we think, secularly will be strong. Cyclically, it's also going to slow, we think, here in 2022, 2023. But companies definitely are embracing automation, robotics, etc., digitization, utilization of computers, etc., to run your businesses. So longer term, we have a pretty optimistic, but unfortunately, we need to squeeze out inflation. We think it is better to have a low inflationary. I think your deflation outlook, Cathie, good gosh, isn't that great if prices go down? What's wrong with low inflation if the economy is healthy? And I would agree with that outlook.
Yeah, and we know that the dollar is up 15%. That's a powerful anti-inflationary force. We mentioned the 10-year bond yield, saying, Fed, you might be making a mistake here. And we're beginning to see that in other fixed income metrics, like the yield curve. The yield curve has flattened from 150 basis points more than a year ago down to roughly 20 basis points. It went negative for a minute, but what this also means is the bond investors believe that inflation or growth is going to be disappointing. And so that's interesting. Typically, when the yield curve goes negative, there is a recession within the 12 to 18 months. And that's certainly post-World War II experience.